everybody, to the Tuesday edition of the Natural Average Investor Show. Today, we talk a lot about how this is such a great asset class. You get all these great returns, but what about the unexpected maintenance charge?
Whoa.
Everybody's scared of the unexpected maintenance charge. Halloween is coming up, so we're here to tell you a scary story. Scary. About a $6,000 unforeseen maintenance expense early on in the investment. I'm your host, Pablo Gonzalez. With me, as always, the guy that I like to call GC because of his genius cash flow concepts, because he generates cash flows, and because he's a great co-host, and because his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Great to be with you.
And with us, as always, our favorite community manager of all time. She brings us the moments that matter. And so that we call her MTM, and because her name is Madison the Magnificent. Say hello, Madison.
Hi, everybody.
I'm a little off today, guys.
Crushing so far.
I'm having a real hard time with the words coming out of my mouth, but I fully expect you to support me here. And I know that the community's in the house. They're joining us live right now. So if you're joining us on YouTube or you're joining us on the podcast and you're confused why I said that it's Tuesday when it's really a Monday that you actually watch this thing, that's because we do this live in studio every single week. We generally get 120 to 150 people joining us live. And if you want to be part of the studio audience, you want to ask a question to little genius concepts over here, or you want to make a friend in the chat, or you want to create yourself a new nickname, go to nyais.com. That's where you can register for our shows. You're going to get weekly reminders. No big deal. A text, an email here or there with the subject of what we're talking about, and you can choose to join in. So I just highly, highly recommend go to nyais.com. That's naturalaverageinvestorshow.com, NYAIS. Sign up, get it on your calendar, and one of these days for lunch, if you're on the East Coast, or for a late breakfast on the West Coast, you can come hang out with us. What do you think about you?
I love it. Come join the party.
Come join the party. And when you join the party, there's a little initiation to every single party, GC. What's it called?
It's called the roll call, baby.
Today, first on the roll call is Denny Davis with a
Pig suey.
Pig suey.
I'm not doing that in 2 weeks or 3 weeks when the Gators play Arkansas, though. By the way,
I will not ask you to. We also got the MVP in the house. You ever heard of him?
Mr. Lee Bishop.
Mr. Lee Bishop. We got the ringmaster of the Natural Average Investor Show community,
Drew Barnhill.
We got the leadoff hitter batting fourth today.
All right, John Henning.
We got our regulars, our favorite second family of the Natural Average Investor Show community from Marietta, California, Rosalind and Gary Riley.
We regard you.
We got the mountain man.
Billy Green.
From the Frosted Mountains of Colorado. We got the Shaman.
Nadeem Shah.
With his trademark good morning, good afternoon from the West Coast. We've got Big Papa in the house. We love it when he calls him Big Papa.
Pops, how are you, man? Good to see you.
Jay Cohen, Gregg's dad. We like to call him Big Papa for obvious reasons. We got the early bird in the house.
Dean Curry.
Dean Curry from Columbus, Ohio. We got the Maven from the mountains of Denver.
Ms. Leslie Wilson.
You know that Denver doesn't actually have mountains. Denver's actually pretty plain. It's just the mountains are right next to Denver.
Interesting.
It's basically Kansas up until Denver, and then it's the Rocky Mountains.
Had no clue.
Well, now you
learn something new every day.
But we got the Maven in the house, always adding value. We got Donna Chica back in the house from
past star of the show.
Good to have you back, Donna. Who else we got in here checking it? We got Marty Quinn from Golden, Colorado.
Is that a new name?
New name.
All right, Marty, welcome to the party.
Oh, Marty, do you know the mountain man? Are you familiar with it or the Maven from Colorado?
No, the mountain man.
Marty, hope you make it a habit. We got the Mama Bear in the house.
Cody Adams, good
to have you in here, Cody. We got Robin Schofield in the house from New Hampshire, making it a habit. Robin, we love having you. Thank you for showing up again. We got the first family of the Natural Average Investor Show, the patriarch and matriarch, Ken and Carolyn Moline.
We salute you.
What else we got in here? We got Marilyn Connerman from Homosassa, Florida.
Yes, that is the home of the manatees, Pablo.
Of the manatees. It's about this time of year that manatees and people flock to Homosassa to swim together, everybody. Go check out Homosassa, Florida. It's a wonderful place. I'm making plans for it myself. Mary Rockoff from Arizona is in the house. Good
All
to
right,
have you.
Mary.
Mary back in here. Who else we got? The name's scrolling through. Chris Consaga.
From the wonderful, illustrious Hudson Valley.
The illustrious Hudson Valley of New York. Chris Consaga, good to have you back as well.
Been a little while. Good to see you, Chris.
In a minute, you kind of lost your illustriousness for a little bit.
I did. It was in there somewhere. It was wonderful and illustrious.
You were lacking illustriousness for a little time. All right, GC, let's get into this story, man. I feel like this idea of an unforeseen maintenance expense is one of the biggest hangups
that
people generally have with this asset class. People know real estate's great. right? Like they know that more millionaires and wealth is created through real estate in America than any other mechanism or lever or asset class or whatever it's called. And yet people fear this idea of what they don't know could happen. Can you talk a little bit about that?
Yeah. The most painful time of owning a rental property is when, the double whammy happens where your property is vacant because the resident moves out and you are hit with a big maintenance expense. And, unfortunately, it can cause people to make rash decisions, maybe decisions that aren't in their best interest as far as their goals, and maybe as far as they're not in their best interest as far as their best return on investment as well. And the reason is because it's so painful, right? Other assets, you don't have the cash flow ramifications that you would have in rental property investing. In rental property investing, the whole property management premise is here to mitigate the risk of maintenance and vacancy, but we're not perfect, right? It is a downside to this asset class is that, your property management team can give you a call and will give you a call the longer you own rental properties. And they will have to ask you for a capital contribution. That's otherwise saying, in this example, we're going to talk about a $6,000 capital contribution. So, but the big picture here and what we spend a lot of time talking about with clients is that even though this can happen, this $6,000 maintenance expense can happen, when you take that into account and you look at your overall return on investment, you can still be quite happy. So the challenge for investors out there and the goal for a vertically integrated company like JWB is, how do we manage expectations appropriately from the very beginning? How do we manage cash flow appropriately? How do we have rainy day funds set up in place to make sure that there is cash set aside to handle instances like this with what we'll call capital calls, right? Paying a $6,000 expense on the maintenance side is, we'll just call it a capital call. So you got at the end of the day that this asset class still performs very well, even when you have unexpected circumstances like this. You can manage all of these other things to where clients can still be happy. You can still be happy even if you have a $6,000 maintenance surprise. And that's what I wanted to talk about today is how do you do that? Because if you don't do it to a way where people have the right expectations and the right cash flow management processes set up in place, what you do is you remove access from an asset class that could really help a lot of people out there.
Yeah, GC, as you're telling me all this stuff, I'm kind of remembering, I recently re-listened to our Airbnb episode, right? Where we talked about, the changing dynamics in Airbnb and the context has changed and how like right now Airbnb is kind of like going against City Hall and you don't want to go against City Hall. But one of the takeaways on that show that I came up with was, hey, if you're in one and you can't find a good property manager, you might want to sell it, get a 1031 and get into long-term property and rental properties. But you slowed me down even then because you're a big believer in the idea of holding on to the real estate. And I feel that number one, as we talk about this story and we're trying to shed a light on this idea that it's not that scary to get a $6,000 maintenance expense, right? Like let's demystify it for two reasons. One is because we don't want that fear to stop you from getting into the asset class because we believe that it's going to create long-term wealth for you, particularly right now in Jacksonville with everything that's happening in the economy. But even more so is the idea that if you are already owning a rental property and you come up to this situation, is helping you see the forest through the trees, right? Is like helping you see that, beyond, again, we talk about data with perspective, situation with perspective, right? Like beyond the pain that you're going to endure in the short term,
right?
The real benefit of this asset class is holding on to it for a full market cycle, letting real estate do its thing, keeping up with inflation, appreciating, providing cash flow, letting your debt get paid down, saving you on taxes. So it's just really, really important for us to know it before we get there, right? It's like an inevitable piece of the experience. So for, you already as a provider of rental properties, You build it into your assumptions that this type of stuff is going to happen. You sell it as such already in the assumption, but we're trying to prepare people for the emotions of it when it happens.
Exactly. If you already have the money set aside to take care of an unforeseen thing like this, and you're already told that things like this can happen, and the longer that you own these assets, they probably will happen very infrequently, that when it does happen, you're prepared. And when you are prepared to kind of step out of the emotion of the moment, you're able to follow through on the plan that you had. And the plan that you have when you put rental properties into your portfolio is a plan that leads to a better risk-adjusted return on investment, even though this stuff kind of happens every once in a while. And that's what we're here to help people see.
All right, man. Should we jump into a real life scary story of rental property investing?
Ooh, I'm ready. I'm ready.
Okay, here we go. We should have dressed up for this, by the way.
We should.
All right, here we go. So GC, in GC's typical fashion of extra preparation, put together a nice little slideshow for us that we're going to go through. So if you're listening on the podcast, you might want to check out the YouTube because this is really hard-hitting multimedia stuff.
Oh man,
that we're dealing with here.
I put this whole little formatting behind this on the front side. I was doing a presentation similar to this to the team this morning, and I got a standing ovation because they know how terrible I am at graphics and putting formats together on PowerPoint presentations. So I'll just assume there's a big applause out there waiting for me right now.
This is adorbs. All right, here we go. So who are we looking at here, GC?
So we're going to talk about everything that we just sort of teased here through the lens of a current client and one of our absolute favorites. Marv and Denise Smith came to us in 2012 and, immediately, landed in a special place in our hearts here at JWB. When I think about the type of client relationship we're hoping to achieve with our clients, it's one that's built on trust. It's one that's built on, us being a great resource to that client and them looking and seeking and listening and, challenging our thoughts on this, but truly listening so that we can help as much as possible. And that's what I think about with Marv and Denise. I think about clients that share their why, the reason that they're investing. And it always, always, always is more than just, more money, right? There's always something that's driving. So those clients that share that with us, and, we probably have an entire catalog of pictures from Marv and Denise over the last 10 plus years. And you can see here, they're avid fisher people. They live in Alaska. Just an incredible relationship, and one that when we talk to the team, this is what we hope to replicate over and over and over again.
GC, I don't want to get too far into it. We're going to talk about what worked for them later on, right? But hey, I look at these pictures, I see two things. One, they're great fishermen, right? Like they're clearly good at fishing here. But two, Marv and Denise look a little, how would you say, advanced in life? Like this doesn't seem like the typical person that says, oh my God, yeah, rental properties is a great idea, but I'm 50. Why, I wish I would have done this when I was 30. They look like they're beyond that age right here.
Maybe not your average investor mindset, if you would. Yeah, absolutely. Marv and Denise actually came to us. We were speaking at a conference for self-directed retirement accounts, and folks were going, Marv and Denise went there to learn alternative ways to invest with their retirement accounts. And we, of course, hit it off. They came as clients. We put a plan together for Marv and Denise based on their goals, and that entailed owning 8 properties with us. But the cool thing is that when Marv and Denise came to that conference, they were only thinking about investing in their retirement accounts. Through our relationship and the trust that they put in us and the resource that we could be for them, we started to uncover other things that we could do with their portfolio. We were able to show them that not only could they only invest with their retirement accounts, but they could actually invest outside of their retirement accounts and get loans. They're retired military. First of all, thank you for your service. But second of all, when you don't have additional income coming in off the bat, sometimes you might believe that you can't get qualified to buy properties outside of your retirement accounts and get the loans that are necessary. We were able to work with them and show them a way that they could do that through their military benefits. We're also able to partner with a lender who specifically was able to get them qualified. And this is all going to make a lot of difference here. The reason I'm going so in depth here is because the asset that we're going to talk about that, of course, had some challenges is one that, of course, also had some upside. And they never would have been able to buy that one had we not been there as a part of that plan, as a part of that resource. And it's, as you see how this thing played out, it's kind of a big deal that they bought this one.
That makes sense, man. And listen, what I heard in your story is what we kind of uncover a lot of the time through our questions and through different things that we cover on the show And it's this idea that most people don't realize how many options they have to invest in rental properties. And you have a team that specializes in uncovering those options. So that's one of those reasons of going to chatwithjwb.com, scheduling a call and just having that conversation. Because if you're listening to this, you're probably interested.
Mm-hmm.
And if you haven't gone on the call, you're probably thinking it's because I'm not ready yet or whatever. But I think the conversation of expressing your situation and going through that first call process so that you can find out tailored specific to you of, man, is it a retirement benefit that you have because you're military that's going to allow you to get conventional finances that gets you there? Is it the idea that you have enough stuff in your retirement to do it through a non-recourse loan or different kinds of things, right? Worth hopping on a call with chatwithjwb.com. If you're interested in this stuff and you just don't think you're ready, get the ball rolling and just have that conversation because you might be more ready than you think. That being said, Marvin Denise did that. And let's talk about that experience.
Let's do it.
Yeah.
So, and we talked a little bit about the 3 phases of the investment here, right? We talked about the acquisitions phase. So in the way that we serve clients overall, if you think about it from the beginning to the end, there's an acquisitions phase, there's a portfolio management phase, and there's a distribution phase. Acquisitions phase is sitting down, building that plan, looking for ways to help them get to their final goal of passive income or overall wealth creation, growth of their portfolio. How do we get there? And so when we break that down, we looked with Marvin Denise and said, wow, did you guys know that you could actually buy properties outside of your retirement accounts as well? Mm-hmm. And so you start to see the value of the acquisition phase for our team.
Cool.
So through that, this property here on Jasper Avenue is one of 2 that they bought outside of retirement accounts with conventional financing in place, and one that they never would have bought had they not come to our team and understood how to do this and matched with the lender and all that good stuff. Overall, Marvin Denise had 8 properties with us. And so, but I'm going to highlight this one because this one has its set of challenges and it's set of good things. So we'll talk about that more in detail.
Got it. So they bought 8 properties. We are right now going to talk about this one because we are giving the story. Mm-hmm. That's for you, Bill Green, who wanted sound effects. All right, here we go.
Now, the portfolio management part of this, this is everything that's in between acquisitions and distribution. And portfolio management is, we are here to be this resource in great times and to communicate effectively when times are great, to, share the numbers about how great this investment is going. And then we're there in times of unforeseen challenges as well. And we're probably even more important in those times, helping folks think through the investment without the emotional component and truly focusing on what is right for your goals at this moment and what is right for your best return on investment. And when folks are going through a challenging time, call it a $6,000 property turn, that level of resource is critical.
Yeah.
Because many people don't have that resource and something bad happens in rental properties. They don't understand how good things are happening around it. Yeah. And they throw their hands up in the air. They run away from that rental property. They probably sell it at a discount to market value because it's an emotional decision. And then they're out of this asset class forever. And so our team spends a lot of time building that relationship so that when those challenging times can happen, we can be there to help.
As you talk about that, I think about the class, right, that we have together at nyaiclass.com. Highly recommend you check it out.
Well done there. Product placement.
Check it out. But one of the biggest takeaways there is, why we talk so much about vertical integration and about having a professional property manager and all these different things. And it's the idea that the average investor that invests with an average property manager during this time, it's their worst time. And it's when they're most in disalignment with their property management team, right? Like at this point, the property manager, if you didn't select it correctly, might be ghosting you. They might just be too busy because they're trying to fill the, worst case scenario, they're ghosting you. Good case scenario, they're just super, super busy trying to fill this thing, but they're not sitting there making all these calculations. But the difference between a vertically integrated professional property management provider and not is the idea that they're talking to you at a investment level, right? They're talking about your asset and they're talking about how your asset performs. And they have people in-house that are looking at each different metric. And there's one person that's handling the vacancy and the turn and all these different things. One person for each of those things, as we learned a couple of weeks ago with Ali. But then there's also the person that's telling you, hey, listen, this is the projection. This is where you're at right now. This is where you stand to gain based on where we're at with months of inventory and appreciation and different things. So again, you can see the forest through the trees, and that's just critical, whether you're investing with JWB in Jacksonville or anywhere else, is finding that team that allows you to see this thing as an asset, not a house, right? Not
your house.
Not your house, correct.
Yeah.
So I'm glad you hit on that. All right.
So here's what happened, right? They bought in 2013. Things were going swimmingly. And in 2017, out of nowhere, this $6,000 maintenance cost happens. That's what you see on the screen. Results in a negative return on investment for that year. How do you think people feel? Let's go general public. Who is investing in rental properties. If they have a $6,000 maintenance expense out of nowhere, how do they feel at that moment?
I mean, it feels like someone punched you in the stomach, right? Like when you get that call or you get that bill, it feels like you just got punched in the stomach, essentially.
Absolutely. What might that lead you to do?
That might lead, I think that leads to conversations between whoever had the idea to have this investment and the person that was like, yeah, I trust you in the home, to be like, I told you something like this was going to happen. See, now we got to go take money out of this. What are we going to do? We should get rid of this thing, right? Like what if this happens again? Like this house is right now vacant. What if it stays vacant for 6-7 months? We're paying this mortgage, right? Like those are the conversations that happen, right? Like,
and if let's say that you earned $2,500 a month in positive cash flow for the 3 previous years, are you thinking about that at that moment to offset this? No. Most rental property investors have no tracking set up, so they wouldn't have that reference point to see the good positive cash flow that came in. Other things, simply, most rental property investors just have all of their, call it rental income, going into their, call it their family checking account. And they have everything in one bank account. And, in theory, there's nothing wrong with that. It's the same amount of money. But in emotional context, there's a lot of challenges that come with putting it all in one bank account, right? Because you can't figure out how much excess surplus you earned for the few years before. And nobody likes a $6,000 cost coming out of their family checking account with no warning. But now let's talk about Marvin Denise, right? So whenever we bring a client on board, we talk about the complex things. We talk about the simple things. We talk about effective cash flow management. And we talk about how important it is for you to set up a separate bank account to have your rental income for JWB properties and your expenses going out of that separate bank account. So that way, where that money is when it is needed. You can put effective amounts of reserves in place in that bank account, and it's separate from your family activities, right? If we want people to think about this as an investment and not your house, well, let's keep it as the investment bank account than it is, tied in with your family activities. So that's just a simple thing that we do that I would recommend for everybody out there. It's going to help you make better, more sound decisions. Marvin and Denise, of course, do that. We also talk about effective maintenance reserves or reserves in place, right? So much of this is cash flow management. You got to realize in other places that you put your money, there are inflows and outflows, but there's effective reserves that are in place. Or you might be in another investment that doesn't have inflows and outflows, and you don't need reserves. You just never have to think about there being outflows. So if you think about investments where you put your money, if there is a potential for an outflow, make sure you're putting enough reserves in place so that by all accounts, the vast majority of outflows are already taken care of. That's just cash flow management. And it helps you be emotionally, it helps you be objective. It helps you make the right decisions instead of being emotionally charged on it.
Yeah. So I'm hearing 2 pieces of advice. One is for the psychological component. I'm going to return to that in a second, right? But then there's just the fiscal component, right? Like are we above water, is making sure that when you enter this asset class, you have that cushion, you have some reserves set aside to weather these moments. And that's imperative. And it sounds like when you go with chat with jwb.com, when you get into this process, that is quickly identified 100% before anybody jumps in. Then the second thing that you're talking about to me is more psychological management, right? Like this idea that if you grab those reserves that you have already set aside for this, you put it in a separate bank account, and you have the positive cash flow month to month coming in on that bank account. and then you have any kind of like unforeseen expense coming out of that bank account. And that creates a segmentation in your brain of, this isn't coming out of my grocery money, and it's not coming out of my savings either. It's coming out of my rental property fund. And that, you know, we talk about this a lot in our morning runs, GC. It's this idea that would make it seem much closer to other investments that we are used to having, right? Like if I have money in the stock market and the stock market takes a 25% dip, I see it on an electronic ledger, and I know that my net worth just took a total haircut, but I didn't have to go into that same bucket of, you know, into that same segment of my brain where I was going to pay for my groceries, or where I was planning to pay for my vacation next year or something like that. And that inherently will create a bad experience because of the psychology of it. You want to say a little bit about that?
And just at the foundation here, if you look at returns on investment, when you properly use leverage in real estate and in rental property specifically, they're better. Returns are better, and volatility is lower. So at the end of the day, what we all need to rally around is that the numbers are what they are. This asset class has better returns when you know how to use leverage appropriately, and it has less volatility. So we then need to manage, you know, cash flow management. We need to manage our emotions. We need to manage the client experience. We need to manage our psychology around this so that we can put ourselves in a position where we can take advantage of a better asset class. You know, so all of those things are a component of getting to a place where a client can look at this and say, I'm never going to be happy, but can look at this and say, okay, all right, you know, Greg or JWB teammate, okay, well, you know what? I was prepared for this. I'm not happy about it. What are we going to do about it to get it to perform exactly the way it was prior to this? You know, and, you know, the bank account thing, I think is critical. It's simple, but it's critical because if you have all of your positive cash flow going into that bank account for 3-4 years, that's cash flow management in itself. Sometimes what people do is take the positive cash flow that they're earning from the rental properties and go and spend it on other things. And they feel like they didn't get any positive cash flow. But in reality, for Marv and Denise, they had it set aside. It was in a separate bank account. They had, you know, 3-4 years of $2,500 a month, let's say, piling up there. So when it came time for them to spend $6,000, they didn't go into the Marv and Denise bank account for their family. They went to the JWB bank account, which had, call it, you know, $8,000-$10,000 sitting in there. And that's why they could weather the storm. And they were not in a position where they're like, I'm out, right? They did not put themselves in a position to make an emotionally charged, short-sighted decision, which unfortunately many rental property investors do.
Got it. All right. So that's the decision-making process. That's how it went. How does that go when you are talking to them, right? Like, what do you have any purview into, like, who was dealing with him or how it went?
We know our team worked with them. I asked the team early on in the presentation I did this morning, I said, talk to me about Marv and Denise. What words come to mind when you see Marv and Denise? And it was sweet. It was compassionate. It was positive. It was trusting. It was Alaska. It was fish, you know? So, you know, and I know, and I love highlighting, you know, clients that have had tough examples, like tough times that we go through, because I see it daily that you can go through a tough time on a property and still have a positive outlook on this investment, still truly know that this is the best place to put your money. And, you know, so that was the type of conversation that our team had, you know. And then you got to understand, this is part of a robust portfolio for Marv and Denise too. They had 7 other properties that were also contributing. So it's easier to weather the storm as well when you have more and more of a robust portfolio like they did.
Got it. Okay. So, you know, spoiler alert, Marv and Denise kept the property, right?
They did.
So are we going to talk about
or
where we're going next?
So let's talk about the decision. Again, I like to juxtapose this, write that down, SAT word. Okay. Juxtapose this versus the way that, you know, kind of general investors might make a decision. If a general investor, rental property investor, you know, has a $6,000 turn, you know, they might say, oh, I'm going to throw my hands up. I'm going to run away from this asset. I'm going to sell it. I never want anything to do with rental properties again. Well, if you think about it, if you make that decision, you are selling at a very low point of your investment, because when a $6,000 property a $6,000 cost happens, it's most likely when there's a property turn. That means the resident moves out. You spend this $6,000 because there was more maintenance costs required to put it back into great rental shape. But what happens after that, right? What happens in terms of rental income after that $6,000 turn, most likely, Pablo?
I would assume that the rental income stabilizes for the period shortly thereafter.
Not just stabilizes, it does stabilize, but when your home is rented, you're producing more positive cash flow than we told you to expect on your pro forma, on your property evaluation. You're earning more and more of a surplus that eventually will be used when a negative item happens. So you, in essence, would be selling at a very low point. What else happens for maintenance costs? After you have a property turn and you just spent $6,000 on putting the home into great rental shape and you have a new resident that comes in place, what generally happens to maintenance costs when it's occupied?
Maintenance costs will probably go away for a while.
Probably go away.
Yeah.
So if you're thinking about selling when a property turn happens, you're very likely selling at a very low point for your investment. It doesn't make a whole lot of sense to do that generally. And that's why you have to separate the emotion. You have to have the ability to make a decision and get outside of the emotion of that negative experience.
Got it. So at this most painful moment, when you have this unforeseen maintenance expense, is also the worst moment to exit for a couple of different reasons. A, because you just laid out a whole bunch of cash that you would have to lay out this cash anyways, right?
In theory, yeah, you'd have to lay it out anyways. Even if you want to go and sell it, the property is going to have to be repaired for you to be able to get the most selling price for yourself. So yeah, at a bare minimum, you'd have to lay this out.
So you got to lay this thing out. You would be exiting right after, like your most expensive month instead of like exiting out on top, but also you would be giving up this idea that you just laid this thing out, which by laying it out, by definition, you are setting yourself up for short-term success in the near future. So you're giving up the upside of that part of it. So, at the very least, it sounds almost like if you're going to lay this thing out to get the property in selling shape, you might as well lay it out and then stay for another tenant.
Yeah, just separating the emotion of it, it makes very little financial sense for you to incur this loss and then think about selling there. Think about other places that you're putting your money in. Everybody says don't do that. We're like, well, don't do that in rental property investing.
Yeah. Yeah. Okay, cool. Anything else?
No, I mean, we'll show you what the next ensuing years looked like.
Okay.
Just to kind of illustrate that point. Yeah. So this is that same property in years 2018 through 2023. Maintenance costs is the first thing that I circled there. Well, you don't see anything close to $6,000. Maintenance costs were right in line. And this is what you generally see when somebody is living in the home. Generally when somebody's living in the home, your maintenance costs are lower than expected. Your rental income is high and your overall cash flow is higher than what you're expecting. You're creating a surplus. And that's, of course, what we have seen for Marvin Denise all the way through this year.
So for those of you listening on the podcast, right, we're seeing a maintenance cost in 2018 of $305, 2019 of $1,107, 2020, $325, no maintenance 2021, 2022, $900, 2023, $95. Was this 2019? Does this look like maybe they had a 2-year lease and there was a turn here at the end of 2019 and then they stayed in there for the next 4 years?
No, I don't think so. And the reason is because if you look at gross rental income, which is just 2 line items right above that, you can see that gross rental income was consistent and going up. So to me that, and what that means is we had a resident in there ever since the last one left. And, you do have maintenance costs that do happen when homes are occupied for whatever reason. Tree branch could fall on a house or whatever, So, but all of those costs, if you take that's 5 years, 6 years of a maintenance cost, you total that up and you compare that to what the expected maintenance cost would be based on our pro forma, that's a whole lot less than what it would be expected to be. And that's what typically happens when homes are occupied. And especially that's what happens after turns happen because homes are occupied.
Got it. Okay. Let's go on to the next slide then.
Yeah. And then, if we're talking about how we are here to be a good steward of your money, we're not just suggesting to you to hold on to the asset because, we want you to hold on to the asset. It's because the returns on investment are generally higher after a property turn happens. And that's what you can see here. The returns are ginormous, technical term there for Marvin Denise. I also want to point out that this doesn't include home price appreciation in these returns. So it's that balance here of understanding what's right for your goals, understanding how this asset is built to perform, and then understanding what's the best risk-adjusted return for you, that's how we're going to make recommendations for investors that might be going through a tough time.
There you go. So for the 6 years after, not including home pricing returns, we're looking at returns of 30%, 25%, 23%, 26%, 26%, 22%. So holding true to what you said, after the big maintenance expense comes low maintenance for the next 6 years and really good returns for the next 6 years. All right, cool. Sounds
there
good.
you go.
Yep, good to see it.
Well, what else happened? We didn't only have positive cash flow coming because we expected that we would have more rental income, higher rental income, low expenses after the property turn. Well, it was 2017. And we weren't doing the show in 2017, but if we were doing the show in 2017, we would have been looking at metrics that would have predicted that we would have had higher than normal home price appreciation. Mm-hmm. The one that we talk about often on the show is months of inventory. Months of inventory is a leading indicator for higher than normal home price appreciation, normal home price appreciation, or below. And really, since the year 2013, 2014, it has indicated higher than normal home price appreciation. So 2017 is that line that I put in the chart here. All of the home price appreciation that happened after the fact is not something that Marvin and Denise would have experienced had they just made a short-sighted decision, had they not had the help of a vertically integrated provider like JWB. If they had just been on their own, they may have made a very, very poor decision at that time.
Got it.
But, I thought we should spend a couple of minutes talking about distribution because, sometimes folks think that, we can only really help with the acquisition side. Sometimes they think, well, certainly we'll be here on the portfolio management side or the property management side, but they don't know how helpful we can be when it comes to distributing the asset. That would be the third phase of a rental property investment. Distribution means largely it can mean either holding on to the asset and then making sure that you're, having sizable distributions coming from your rental income. It can mean that, but for a lot of folks, what it means is, when do we need to sell? When is it right for us to sell? And so we love those conversations. We view ourselves as a resource for all of you out there. And if it lines up with your goals and it's the right thing to do from a risk-adjusted return on investment perspective, we're going to be that resource for you when it comes to sell. We'll put a plan in place for you to sell. We will help facilitate all of those processes that go along with selling so that, Marvin and Denise, who live in Alaska, can have a thorough strategic plan to liquidate the assets. And so that's what they did, right? They have sold a number of homes. I believe they've sold 4 homes with us now. And we did this over a period of years. And so I wanted to make sure that we kind of break down this myth that, JWB is only here for the acquisitions phase or that, we're not a part of the sales process. We 100% are. There's no way for us to be a great resource if we just shut our minds down to the idea that, there might be a right time for somebody to sell. And so that's what we did with Marvin and Denise. It became time. It was right for their goals for them to liquidate on a strategic schedule. When we think about the best way to do that, we can really help increase your returns on investment. If we're thoughtful about this, one thing we can do is be strategic. And when a lease is coming up, a lease is ending, we can make sure that we focus on, selling that asset at that point. So we don't have to, run into challenges with current leases that are in place so that we can do this in a way that can get you the highest sales price on the market. So there's a lot that we can do there. And that's what we did for Marvin and Denise. And that's the same thing we would do for any client. So if the sales process has been holding you back and thinking, oh, well, I don't know how I'm going to liquidate, make sure you look for a vertically integrated provider who can help you.
Yeah. So got it. So, one of the things that I find interesting in the story is we've gone through a lot of property stories and comparisons, and we talk about IRRs in the future of after selling. This is actually a couple that held for 10 years and sold 10 years later. So these numbers that we're going to discuss, this performance that we're discussing, are real numbers.
100%. I'm excited about that too.
Got it. Let's talk about it.
So we put this 10-year case study together for this home here for Marvin and Denise, and the numbers are just really, really fun. They're really, really exciting to look at. And knowing that they didn't have a picture perfect experience makes it even that sweeter. So for your 5 profit centers for net rental income, they earned over $34,800 in net rental income. That's income that they earn as far as the rents minus all of the expenses that come along with it, of which that $6,000 property turn was a part of that. Right? You can think about the fact that they wouldn't have earned nearly as much in that if they had just sold when they took that $6,000 hit. right? Their net rental income would have been significantly less. And so they made a sound decision with our guidance to make sure that they held on for a full market cycle, and they really benefited there. Tax savings, earned almost $4,000 in taxes they didn't have to spend by deferring income through what's called depreciation from a tax perspective, not from market value perspective, tax perspective. So $4,000 that they did not have to spend in taxes because of the beautiful tax savings component of this asset class. Principal pay down. This is where the residents are paying down the loans for all of you out there who invest with JWB and who own rental properties, and definitely for Marv and Denise. And this principal pay down is something that I call sneaky fun. And it's because if you look at your bank account, you don't see it. You don't see it. It's off in your loan balance with your lender, and it's going down month after month after month. But if you follow the model here, if you follow the JWB model, you hold on for a full market cycle, you're going to wake up one day and realize that $15,000 of your loan was paid down. $30,000 of your loan was paid down, maybe more. You might have the entire loan paid off, depending on how long of a case study we're doing. And that's real. I think back about Tim Hicks was a JWB client and a past star of the show. And he talked about it. And he said, when I started to invest with JWB, he said, I really liked what they had to say. I felt really good about them. I trusted them. But at the end of the day, I looked at it and said, listen, if I don't get any home price appreciation, if my rents don't grow over time, I'm just looking at this as my residents paying off the loan for me. And I know I'm going to win.
Yeah. Yeah.
And so that certainly contributed there. And then we've got home price appreciation. $150,000 of home price appreciation. Again, this isn't an expectation. This isn't built on assumptions. This is the fact that they bought that house for $95,000 and they sold it for $245,000.
Pretty good.
And this is real. This is the reason, number one, why you invest with the right team, so that you are enjoying the process of holding on for a full market cycle. That's why that's the number one priority, is pick the right team. Number two, pick the right market. There are markets that win with home price appreciation, and there are markets that lose when it comes to home price appreciation. So choose the right team, choose the right market. And then if you do that well, the physical properties that go into the portfolio will be easy. They will be the easy part of the decision. And you should think of them as widgets, because if you get number one and number two right, that team is going to put the right widgets in your portfolio to have an outcome just like Marv and Denise here.
Got it. So 4 profit centers here, hard at work, shown for Marv and Denise, total net rental income of $34,000. This is just, they own 8 properties. This is just for the one property that we talked about that had the $6,000 expense. So at the end of the day, $34.8 grand in rental income for the life of it, $4,000 in tax savings, $15 grand in total principal pay down of their resident paying off their experience, as Tim Hicks famously coined it for us. And then the home price appreciation of $150 grand just from this one house itself. What did that bring us to, GC?
Well, we're going to get there in just a second, but let's hit this same pie chart that we talk about over and over and over again. I'm going to keep hitting this pie chart because it's that important. We have to understand how your overall return on investment is going to be totaled up after you buy and hold for a full market cycle, which is between 10 to 20 years. When you look back on your portfolio, just like Marv and Denise are now looking back on their portfolio, you're going to see something. What you're going to see is that the biggest contributor to your returns on investment will be your home price appreciation. Here, it's 73% of their total return on investment came from home price appreciation. And you can take any segment of time, give it 10 to 20 years, you can take any segment of time. And what you're going to find is your returns will be driven by 60 to 80% will be driven by home price appreciation as well. So for all of you out there that are just so cash flow focused, you are literally stepping over the dollars to pick up the dimes.
This is why we call it the Pac-Man chart, right? It is a pie chart that shows you how much of the total your returns come from. And inevitably, every single time we show a portfolio, we show a single house in rental property investment in Jacksonville, because it's a growth market, what you always see is this idea that rental income, tax savings, and principal pay downs are the mouth of the Pac-Man, and home price appreciation is the Pac-Man itself. It's just a matter of how wide or how narrow the mouth is open, but it's always what you said, 66 to 78%, whatever it is, that makes up the majority of it. So if you're just like listening on the podcast, just picture a Pac-Man.
Mhm.
And it's a Pac-Man, and then the rest of it is every other profit center, but the main profit center is the body of the Pac-Man, and we see it once again here. So I think it's a powerful graphic.
There you go. So this is how it all ended up. Marvin Denise had an initial JWB investment and then again, this is just one of their assets, but we decided to focus on this one. Between down payment and closing costs, they invested $26,125 over the course of 10 years. Investing with JWB, we were able to generate returns of over $202,000 to bring their total portfolio value over $228,000. Again, this was an asset they never knew they could buy. This was an asset they never knew they could buy. And it's very fulfilling to think about what we've been able to do for them. Their money has grown on this asset with us. It has grown 30.5% each and every year. That's their internal rate of return, another form of their return on investment, 30.5%. Where's your money growing 30.5% year over year over year for the last 10 years?
Hard to find something like that isn't extremely volatile and extremely risky.
Yeah, it's incredible. And, I think the thing that brings this whole thing together is we're not just here to create, returns on investment. We want to know where you're going to put it. We want to know how we're going to change your life. And so for Marvin Denise, they sent us this very warm email, and they send us more pictures, and, they just sent this to us. Hello, Allie. Attached our pictures of our new home in Delta, Alabama. We thank the JWB team for helping us to make this happen. Please share with the team, Marvin Denise. They sent us 10 pictures or so. This is their dream home. They had been working together for this for many, 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 many years. And this $202,000 that we were able to help them create, is making a significant dent in making this a reality for them.
I love that, man. I love that. Very cool. That reminds me of like Jen and Renee, who are in Monterey. They're investing in rental properties. They always talk about this idea that their rental properties are the ones that are going to buy their dream home, not the other way around.
100%.
Which I think is really, really feasible. Powerful case study, GC. I'm glad you shared this with us. What really stands out to me is this idea that I thought the biggest thing was showing the 6 years after it, right? Like the idea that, you might think about it. Yes, it makes sense. Don't sell low, but you also forget about the idea of like, don't sell right before the best period, the honeymoon period,
right? Which
is that time where you have something that you've put a bunch of money into, that it's going to perform really, really well. It's going to have a low headache for the next coming years and a higher rate of return for the next coming years. So at the very least, you want to put that money in and hang on for that.
100%, right? Don't just, and this isn't to say this is always the right advice, right? We're going to sit down as a great resource for you and help you decide what the best thing to do is in a challenging time. But don't just come into this and say, oh, this is the worst investment ever. Oh my goodness, I'm ready to go. I mean, you quite honestly are very likely making a very poor decision with your money to think about it from an emotional perspective that way. We have to sit down. We have to remove the emotion. We have to sit down with folks that have lived and breathed this for over 3,000 properties that we have sold and that we manage and see the returns on investment. I mean, I'm not coming up with any of this stuff here just off the top of my head. I could literally pull thousands of examples just like this for Marvin Denise and show it to you guys. And that's kind of why we do it on the Portfolio of the Week. And so you're able to make sound decisions that are going to help you accomplish your goals. Yeah.
And the other thing is, if Marvin Denise hadn't gone to chat with jwb.com and picked a call and gotten on the call with one of the teams, they wouldn't have realized that they had the availability to pick up this house the way that they did, right? Like they knew that they could do it through their retirement. They didn't realize they also had a way to do it through conventional financing. And that's the other opportunity, is just going to chat with jwb.com and letting them open your eyes to what what you don't know, you don't know, and some of the stuff that you don't know, right? Like it's finding those pieces can lead to this awesome windfall. GC, you ready for a couple questions?
Yeah, baby, let's do it.
All right. Well, number one, Denny Davies with a Woo Pig Suey has I don't know if it's a question, but he says, Gregg/Pobs. Denny, I love the nickname Pobs. Very few people call me that, and it's underrated.
I love that. I call him Pobs.
You call me
Let's
Pobs.
keep this going. I love it.
Yeah. Our worst turnover was $17,000. Additionally, we also had one of the very few JWB renters during COVID who needed to be evicted or took took advantage of the moratorium, right? Lost nearly $20,000 in income, turnover, and vacancy expenses. But end of the day, we're still JWB millionaires. Thanks, JWB. Denny was also saying he was class of 2012 with this investment. And I know you've told me that Denny's been through some hard times.
I love the Denny Davies story.
Yeah.
I mean, Denny is just near and dear to our hearts here at JWB, Denny and his family. And, man, it all hasn't been rosy with Denny. Yep. And it never is perfect.
Yeah.
It's a part of the reason why more people are not in this asset class. It's because it's complex, and you know what? You can have outflows of cash, and that keeps people away if you don't know how to prepare for it. And Denny and his family have dealt with that. Denny owns an extensive portfolio with us, has been with us for, I guess, since 2012, also private lending as well. So he's seen everything about, Denny knows more about JWB than most. I will tell you that. He started to invest with us when it was just, call it a handful of us working in our old office, which was we'll call it a renovated salon, but it wasn't really renovated. I don't know if I've shared pictures with you, but we still had sinks in every single one of our office, like hair salon sinks and still every one of our offices. So Denny probably remembers all that good stuff. So he's seen all this. He's seen all angles of it. And Denny's here pretty much each and every week. And he's here not because he's learning so much about this, how to manage cash flow. He knows that for rental property investors because he's lived it. He's here because of the value of this community. And it's because he's a resource for the community, but I'm sure he gets just as much from everybody else out here. So I love the Denny Davies story. It continues to roll on and on and on. And I just appreciate you for being here and continuing.
I can second that. I know Gregg loves the Denny Davies story. He talks about it often, Denny. So we love you being here, man. And we love you chiming in with stuff like this. Much appreciated. Now a little bit harder questions. Here we go.
Cool.
Billy Green, Mountain Man says, there is a very small chance that I might be facing my first JWB managed eviction due to non-payment. How much would the cost of an eviction possibly be? An eviction might not happen in this case, but it made me realize that I need to prepare for such costs and my separate set-asides.
Yeah. Well, I think preparing for, rainy day fund is a great thing, Bill. So regardless if this turns out to be an eviction for you or not, let's talk about the amount that you have set aside for your funds. And I just encourage you to have that conversation with your portfolio manager. And that way you guys can make the right decision for you. So let's prepare that even if this doesn't happen, that it will happen. And, so much of what we try to do here is to make sure people are enjoying the process to get you to that full market cycle, knowing that there are going to be setbacks along the way. So your question overall is, how much does an eviction cost? Well, if we're just talking about what it costs to process the eviction, I think it's around $700 or so is what the legal fees are to process the eviction. However, there's other costs that are going to come along with that. And the bigger costs are lost rent, right? It's going to be, call it a couple of months of lost rent. And then there will be maintenance costs that you'll have to put into the home to get it into great rental shape. Now, I will tell you, it's not normally $6,000. I chose a higher one because we were going with a real life scary stories theme here. On average, it's about $3,500, $4,000 out of pocket is what an average property turn is costing these days. And then there's tenant placement fees, again, for the new resident coming in the fray there. So talk with the team, Mountain Man, and make sure that we have more than enough set aside so that if and when that rainy day does happen, it's not going to put you in a cash flow bind.
Love that. And I love that you said, Mountain Man.
I know, I did it. I know. It's like, Mountain Man.
Just throw it out there. All right. BJ McKay asks, was this 6K experience structure failure or tenant failure? If tenant failure, was it avoidable with better background checks?
I don't think it was a failure. I just think sometimes it's happened. So I actually did a little bit of a deep dive into what that 6K is made up of. And a lot of it was replacing flooring. So our clients that invested in 2012 and 2013, Denny could probably chime in on this too. When we were building homes or renovating homes, we had carpet in the living areas. And, over time, we understood the benefit of having a hard surface in the living areas. And over time, we invested more on behalf of our clients. And now we have hard surfaces in the living areas. But, if you're an early investor like Marvin Denise and Denny and a number of others here, you probably remember where you had carpet in your living areas. And, so for that $6,000 here, the majority of that was going from carpet to vinyl plank flooring. And you might say, wow, well, why didn't JWB put vinyl plank flooring in the beginning? And you know what? We're not perfect. We're not perfect. In 2012, we weren't perfect. We're not perfect in 2023, but we are committed to getting better over and over and over again. But I ask you, if you can go back to 2020, 2012 or 2013, could you buy that property for $95,000 with carpet? Would you do that? So overall, of course the client wins, but so that's the biggest part of that $6,000 expense was going from carpet to vinyl plank flooring.
Got it. All right, GC, good job today, man. Any final takeaway here?
I love looking at this from the big picture when you actually see all 5 profit centers, but I just am really sensitive to the fact that most people who go through this have no clue about that. Yep. And so, and that's why we do the show. It's because I really feel like the vast majority of folks are just misinformed. Even those who invest in rental properties, they've done such a good thing, but something bad happens and they just kind of adopt more of an average mindset, and they just don't know how beautiful of an asset they have. And maybe they don't have the right management in place, or maybe they don't have the right cash flow management in place, but all those things can be solved. And so, I love looking at case studies like this, especially ones that have gone through the full market cycle and showing how this actually has worked, because I want all of you to have confidence that this asset class is better. The returns on investment speak for themselves. The lack of volatility speaks for itself. And, unfortunately, many people don't know that and they make misguided decisions. So don't be like that. Keep tuning into the show. We'll keep shining a light on this from all 5 profit centers. And, I think it will really have a wonderful impact on your financial future.
Yeah. And bring us situations like this. We love answering the questions. If you ever, like it is, I hope it is clear to you by now that if you bring us a subject, we'll make a show about it, because we know people show up when it's requested by you. If you have the question, chances are there's another 150 people that have the same question. So love to hear from you. Would love to have you in the Facebook group, or following on the podcast, or reaching out to us on social media, jwbfacebookgroup.com. You can find that there. And come on Thursday for a portfolio of the week. Do you have something cooked up for them?
I do. And just a little special throwing it out there announcement. We do have some openings for client journeys, guest investors coming up over the next coming months. So if you'd like to be one of the guest investors that we get to highlight, we would love to have you put your story out there. And of course, show you your return on investment from all 5 profit centers. So you can reach out to Madison in the chat now. You can send an email to info@jwbcompanies.com, and we'll save the seat for you when you're ready.
You get to step into the light like Aaron O'Neill did last week.
That is true.
Which was awesome.
That is true.
And GC goes into your portfolio and does a calculation beyond just what's in your regular investment portal, right? Like you actually calculate all these other things and give you like is this your life? So it's a great experience. Would love to have you on the show. Would love to see you on Thursday. Show up again. But until then, there's one thing that we really would hate if you would do, and that is don't be average.